The American dream of homeownership is facing its toughest test in decades. As we navigate late 2025 and look towards 2026, the U.S. housing market is a complex web of soaring prices, elevated interest rates, and a deep sense of uncertainty. Is it a bubble about to burst or a painful rebalancing act? For millions, the question isn't just, can I afford a home? But is this market fundamentally broken? Reports indicate that home prices have surged by 50% between 2019 and 2024, pushing the median existing home price to over $407,000. Combine these prices with mortgage rates that have hovered between 6.2% and 7% for much of 2025, and you have an affordability crisis of historic proportions. Some experts, like Nick Gurley of Reventure App, are sounding the alarm, stating that the U.S. is currently experiencing the biggest housing bubble of all time in 2025, surpassing even the 2006 peak in inflation-adjusted terms. To understand the gravity, let's look back at the mid-2000s, a period characterized by lax lending standards, speculative buying, and rapidly inflating home values. It culminated in the Great Financial Crisis of 2008. While today's market differs in its underlying causes, primarily a supply shortage and rate lock-in effect, rather than subprime mortgages, the outcome for aspiring homeowners feels similarly prohibitive. Over 57% of U.S. households simply cannot afford a $300,000 home. The median monthly mortgage payment for a typical home reached $3,270 in 2024, requiring an annual income of about $126,670. This staggering figure highlights the widening gap between wages and housing costs. The rate lock-in effect is a major factor. Roughly 69% of existing mortgages have rates of 5% or less. This creates a significant disincentive for homeowners to sell, further constraining supply. So, what's the forecast for 2025 and 2026? Most experts predict a period of stagnation rather than a dramatic crash. National home price growth has slowed significantly, with an annual gain of only 1.3% as of October 2025. Mortgage rates are expected to ease slightly, with Fannie Mae projecting 6.4% by the end of 2025 and dipping below 6% to 5.9% by the end of 2026. The Fed's 3 rate cuts in 2025 have already contributed to this easing. Despite these minor improvements, affordability will remain a key challenge. Existing home sales hit a nearly 30-year low in 2024, and while a modest rebound is expected in 2026, activity will remain well below pre-pandemic levels. Housing inventory is slowly increasing across the U.S., offering buyers a bit more choice and even some negotiating power in certain areas. This is a shift from the intense sellers markets of recent years. Regionally, the market tells different stories. Refuge markets in the Northeast and Midwest, known for their relative affordability, are seeing stronger demand and price growth. Conversely, some Sunbelt markets, like parts of Florida, Texas, Arizona, and California, are experiencing price declines and increased inventory. These areas might be undergoing more significant corrections. The overall U.S. economy remains robust, which can act as a floor for a complete housing collapse. However, housing's significant contribution to GDP means any prolonged stagnation could have broader ripple effects. Who are the winners and losers in this evolving market? Existing homeowners with low mortgage rates are largely locked in, benefiting from equity but losing mobility. First-time buyers and those needing to relocate face significant hurdles. Home builders face a complex environment. Demand for new homes is projected to rise slightly in 2026, but high construction costs and regulatory hurdles persist. For buyers, financial preparedness is paramount. Focus on building strong credit, saving for a substantial down payment, and exploring diverse markets, including the emerging refuge metros. Don't rush into a purchase fueled by fear or FOMO. Sellers should adjust expectations. The days of multiple, over-asking offers may be limited in many areas. Pricing competitively and being open to negotiations will be crucial. The U.S. housing market is undergoing a significant transformation. While a catastrophic crash appears unlikely on a national scale, a sustained period of rebalancing, characterized by slower appreciation and persistent affordability challenges, is the most probable path forward for 2025 and 2026. Stay informed, stay prepared, and remember, opportunity often emerges from periods of uncertainty.